Recording. We are now moving on to third unit. Third unit, you have three sections, 3A, 3B, 3C. Let us discuss about 3A, which deals with your fixed assets. Now we are moving on to fixed assets. Okay, non-current assets. On the balance sheet, you have two types of assets: current assets and non-current assets. We discussed about current assets in the previous class into three sections: accounts receivable, inventories, and investments. Now we are going to discuss the topics, current asset topics. The current assets are again classified into tangible fixed assets and intangible fixed assets. Intangible fixed assets. Tangible fixed asset means it has some substantial, physical capacity. So an asset which has some physical substance is called a tangible asset, like vehicle, motor car, land, buildings, furniture, equipment are the examples. They have some physical substance. Okay, they exist. They exist. The ones which I showed you here all are tangible fixed assets. Tangible fixed assets do have some lifetime. During the lifetime, you should get their usage in the business. An asset which gives you life more than a year in the business is called as fixed asset. So to treat an asset to be a current asset or fixed asset, you should measure the life of its usage in the business. The asset gives you service more than a year in the business, call it as fixed asset. And obviously, gradually the performance of the asset will decrease from time to time. Say a building, land value will go up, that is different issue, but the value of the building will go down. The value of a car will go down. The value of equipment will go down. So an amount which you spend to acquire an asset, the amount which you spend to acquire an asset will gradually decrease in the subsequent years. Therefore, the amount you spend to acquire the asset is treated as sunk cost, and it has to be recognized during the life of its asset. It is called depreciation. Say for example, you purchased a truck for $100,000 in 2015. So the moment you buy an asset, you will evaluate the life of the asset to be used in the business, say 5 years. So 100,000 is an amount spent to acquire an asset which will give service in the business for next 5 years. So obviously there will be no cash outflow in 16, 17, 18 and 2019. Therefore, the amount you spent on acquisition of a car of $100,000 is called sunk cost. And the amount to be recognized as an expense for its wear and tear for using the asset is called as depreciation. Depreciation is to be accumulated from time to time. Why? Because the fixed assets are to be shown at their acquisition value on your balance sheet. Therefore, say for example 100,000 is an amount of asset, and the life of the asset is 5 years. Every year you will have a depreciation of 20,000, which is an expense, will be decreasing your profit and decreasing the asset value as well. but the asset value on your balance sheet should still remain 100,000. Next year, you will show 20,000 as depreciation. Last year's 20,000, this year's 20,000, accumulated depreciation of 40,000, it will decrease from the asset value of 100,000. So the accumulated depreciation will have an history of the depreciation you're charging on the particular asset during its life. That is the reason why please mention the asset acquisition value in the balance sheet followed by the depreciation accumulated. Net carrying value is to be shown in the outer column. Carrying value is the difference between the acquisition value of the asset minus the accumulated depreciation. So the carrying value is the difference between acquisition value and the accumulated depreciation. We will also discuss about intangible assets. Intangible assets do not have any physical substance. They do not have any physical existence. The business organization spent huge amounts to acquire some rights to use in the business, to some technical know-how, some copyrights, patent rights, royalties. The huge amounts are paid to use an asset, but the asset does not have any physical existence. Such an asset is called as intangible asset. Intangible assets include copyrights, trademarks, goodwill of another business when you acquire, okay, then royalties, etc., franchisee rights, etc. This we'll discuss later. Okay, now let us discuss about tangible fixed assets. Property, plant and equipment. In most of the balance sheets, you will have an balance sheet name with PPE. Mostly everything is covered here. All the tangible assets are considered here. PPE, property, that is land and building, plant, the machinery, equipment, vehicles, etc. Then equipment, office equipment, etc. Here, asset, an item which is purchased to be used in the business will become an asset only when the benefit on particular asset is derived more than a period, more than an accounting period. Usually it's a fiscal year, and that should be capitalized. Capitalized means it has to be recorded as an asset on the balance sheet. You have, say, when you acquire any item from outside. I'm using item because I cannot use asset at the moment because there will be a question mark. Say for example, you buy a photocopier, a Xerox machine, say for example for $50,000. $50,000. Along with this, you purchased a $5,000 of photocopy paper, Xerox paper. So the stationery guy is selling both machinery and the paper. The invoice value is 55,000. You paid it by check. So your invoice amount is 55,000. What is to be capitalized and what is to be recorded as OPEX? See, 5,000, the paper which you are going to use, this $5,000 worth of paper you are going to use in 3 months time. So obviously within an accounting period, within a fiscal period, within one accounting period. So obviously this becomes OPEX. Operating expenditure will go to income statement. OPEX will go to income statement. And the remaining 55,000, 50,000, the benefit will be the benefit which you are going to receive from this Xerox machine would be say 5 years. 5 years. So more than one accounting period. Therefore, it becomes CAPEX. So CAPEX means capital expenditure and OPEX means operating expenditure. CAPEX goes to balance sheet. That is called capitalized. Clear. And the entry here would be debit, debit equipment 50K, debit printing stationery 5K, credit bank account or supplier account. If you are buying on credit, so supplier will come, supplier name will come, non-trading supplier will come. So this is the this amount will go to balance sheet. This amount will go to your income statement, and 55K will go to your decrease from your current asset, that is bank balance. Or if you are not paid here, it will increase your current liability, your supplier balance. When you pay it, when you pay it, you will have accounts payable non-trading, accounts payable or creditor. Okay, either it will increase your current liability if you buy it on credit side or credit basis, whereas if you pay the amount, it will decrease your bank balance, that is decrease in your current asset. So the thumb rule is that the benefit should be greater than a year, therefore it has to be capitalized. A capitalized means debit an asset and credit bank or supplier's name. The initial measurement of an asset, say for example, I said Xerox machine, I said plant and machinery, I said buildings, I said vehicle. See, purchase price is different, but subsequent cost of the purchase are different. You purchased a machinery, you purchased a machinery at say $100,000 at supplier's place, but to bring to our place, we spent around 5,000, say for example, 5,000. And it is installed. The machinery is installed. The installation charges you spend say $3,000 installation. And somebody has to provide you training because it's a new asset. If you have any training cost, so asset cost would be transportation charges to bring the asset to a destination, plus installation charges, plus training costs. So 100,000 plus 5,000 plus 3,000 plus 2,000 training costs. 110,000 is going to be capitalized. This amount is to be capitalized. So this becomes capex. Never think that this is a transportation charges and you will record it as transportation debit, bank credit. No, asset debit, bank credit. Here also installation charges debit, bank credit. No, plant and machinery debit, bank account credit. In the narration you can write as you want, but the entry should be asset debit. Likewise, training cost debit, bank account credit. No, machinery debit and bank account credit. So all the subsequent costs, these three, should be debited to asset account but not some other accounts. And this becomes depreciable base. Depreciable base means your depreciation will be charged on this asset but not this value. Once you capitalize the asset, that becomes depreciable base. Depreciable base means the amount which is considered for the calculation of depreciation. Okay, so there are two types of long-term assets. One, tangible, as we discussed. Two, intangible. Tangible, intangible, both should have a life period of greater than 1 year. That is the thumb rule to term them as long-term assets. Intangible assets, tangible assets, in some cases you may have some natural resources as well, like where you extract some oil, coal, timber, gold, etc., etc., which we call it as natural resources. They are also intangible assets, but I showed you here in a different manner. Tangible, intangible, natural resources. Natural resources, you can add it in intangible assets as well. Yeah. What is to be included in the asset? The purchase price of the asset plus all the cost necessary. All the cost necessary you can add as per my previous explanation. You can add transportation, okay, installation and training costs. Transportation, installation and training costs should be added to the value. Then that will become the capital expenditure. Original cost capex equals to original cost plus transportation plus installation plus training costs equals to depreciable base. Certain costs are to be not to be incurred. Okay, certain costs are not to be incurred. For example, an asset is in the port. An asset is imported from Germany and which is in the port. Due to the faulty documents, the documentation insufficient, so that the customs department is not agreeing to clear the asset until unless you produce certain documents, which will take some time, maybe 1 week time. So your supplier has to provide the document that has to be liaised with them. So it takes 1 week time. Obviously the port will charge you for that. Port is charging you say $1,000 per day. $1,000 per day times 7 days, you will have to incur around $7,000. It is not to be included because it is cost of negligence. And any cash discounts which are allowed by your supplier can be deducted from the asset. Like as I said, the asset value is 100,000 and the supplier is giving you say 5,000 cash discount because you are paying down. So 100,000 minus 5,000 plus installation plus transportation plus training costs. Okay, you can do that. So the entry would be debit the asset account, credit bank account. Debit the asset account, credit bank account, or if you buy it on credit basis, you can record a liability, that is supplier account. Never expense it, because as you say asset, it means that it will give you a benefit more than a year. Never debit expense, please. Okay, and the cost of the asset will be allocated like as in my example 110,000. 110,000 was the asset value capex, and we evaluated that this will give you life or service for 5 years. Okay, so how many years we can generate the revenues using this asset? 5 years. 5 years, so it will be 52,000 or 22,000. 22,000 per year you need to recognize as an expense. 22,000 is a non-cash expense which is called depreciation. Depreciation should be debited to your income statement. That is, it is charged to income statement and it will be accumulated in the balance sheet. Okay. Yeah. Interest cost of acquisition. Say for example, when you buy an asset, there would be huge interest when you borrow it or mortgage it. There will be any huge interest you'll have to pay for construction of a building or production of a property or production of a internally generated plant, etc. that should be included in the initial cost. So this is an important point. You can always remember to answer certain MCQs. The interest cost of acquisition, construction, or production of any kind of other asset internally can be used in the initial cost, so that that will also become depreciable base interest charges. Yeah. Now let us learn some journal entries. When you buy an asset, when you buy an asset, debit asset account and credit bank or liability supplier account. Okay. The next, all the subsequent expenses you will follow the same stamp. Okay. Then when you charge depreciation at the end of the year, debit depreciation account, credit, do not credit asset account. As I shown you, explained you that asset is to be shown in the balance sheet. Its historical value. The entire amount of 110,000 is to be shown until fifth year. So you'll have to use an account called accumulated depreciation. Accumulated depreciation you will find only in the balance sheet as a charge against the asset. Means you will have 110,000 in the balance sheet less 22,000 first year. You will have some amount here. This amount 110,000 minus 22,000, this amount is called as carrying value. Please remember, carrying value is the difference between asset value and accumulated depreciation. This is the historical value of the asset. Historical value minus accumulated depreciation. And I'll continue for second year. This is for first year. Second year. Second year again in the balance sheet, your historical value will remain same, 110,000. Historical mean value means the cost of acquisition less accumulated depreciation. Last year 22,000 and current year 22,000 will become 44,000. And you will have carrying value here. Second year carrying value. Carrying value. Sorry. Carrying value. So this will never be reduced until fifth year. Only carrying value will go down year by year. That is the reason why you maintain a separate account called accumulated depreciation account. Okay.
Sir, we won't record other entry, third entry.
What happens when you acquire the land? Land. Land does not have any transportation cost. Land does not have any installation charges. Land does not have any training costs, etc. But it has got its own specifications to before you acquire. Obviously you need to find whether the land has good title or not, clear title or not, or land is in good shape or not. The surveying cost, whether it is the measurement of the land is same as the vendor is saying, and various other things are to be found, like you need to go for some legal obligations that within 15 days if anybody is having obligations against the buying of this land, then can come forward to our attorney or something like that. So you'll have lots of other costs unlike fixed assets, other fixed assets. So those costs include surveying costs, commissions paid to the finder of the land. Sometimes you need to pay for lots of money for title searches, who is the real owner, etc. Clearing of land. So the land may not be in a good condition to use it. Therefore, you will have to have some preliminary activities to make the land in a useful manner. So the amount you spend to acquire the land, get it registered, and clear it. In other words, prepare the land for the designated purpose. It should be in a shape where you want it. Until then, whatever the cost you incurred, that should be added in the land cost. Until then, don't close land account, do not capitalize it. So open the account. Open the account, land account debit, land account debit, land account debit. So you will have multiple debits depending upon the cost you incur. Even before you pay to the original owner of the land, you will have to pay some amount, preliminary expenses like title searches, like legal expenses, etc. Then you pay big amount to the owner of the land. Then you pay some clearance of certain things on the land. So the total amount will become land cost here. And does not land will not have any wear and tear, so there will be no depreciation on land. Instead, there will be an appreciation. So do not charge any depreciation on land, please. So all these costs should be added to land. Land has unlimited useful life, so it is not to be depreciated. Natural resources. You may acquire some land for extracting some coal or or gold, etc., etc. In that case, you will have a landlord. Landlord will give you the land for say 5 years. During the 5 years, you will extract the natural resources, and this land is to be handed over to the original owner. So what amount you are paying for these 5 years, that will become an asset. This is to be recorded as an asset, natural resources. Okay, and this has to be acquired. This is to be charged in 5 years' time, depending upon the material you extract. In the case of land, please remember these points, very important points. What costs are to be included in the you know uh, uh, long-term assets? In the case of land, in the case of building, in the case of plant and machinery, etc. In case of buildings, when you purchase ready buildings, purchase price of the building, the taxes you pay, the title search, registration costs, any realtor's fee, lawyer's fee, and any remodeling costs before you occupy the building. Remodeling. So these are all to be added into building account. Then you capitalize it, start depreciating it. Equipment, a plant, a machinery. The original cost of the price, original cost of the asset, less any cash discounts allowed by the supplier, plus sales taxes, plus transportation charges, installation charges, and of course there will be some training charges. Cost to adapt the intent to intended use means training costs. The supplier or third party will provide you training costs, training services for which you need to pay some amount. In case of land, very important, MCQs would be asked mostly on the land based questions. Land, purchase price of the land, sales taxes or the purchase taxes, whatever you pay, registration, etc. Title search, transfer document costs, realtor's fee, lawyer's fee, cost of removal of old buildings. If you have any, you know, uh, constructed buildings at the time of purchase which you do not want, obviously you'll have to remove them to use the land for an intended use. So, what cost you incurred to remove the old, substances? At the same time, grading costs. Sometimes the land may not be in a good position. Therefore, it has to be graded. So grading cost should also be added. If you remember these points, bullet points, you will be able to answer a question. There will not be any numbers, or there may be a small numbers that purchase price is this much, sales tax is this much, grading cost is this much, and one more cost is given which is out of this syllabus. So you'll have to know the bullet points very clearly, what is to be included in each kind of asset. The important terms which you need to know is depreciation, amortization. Depreciation is an amount of wear and tear charged on the tangible assets, whereas amortization is an amount of depreciation charged on intangible assets. Depreciation is charged on tangible assets, and amortization is charged on intangible assets. Treatment is same. Both will go to income statement in the first instance and deduct from balance sheet item. The treatment is same, the terms are different. The moment you see amortization, it means that the amount of depreciation charged on intangible assets. Treatment is same, both are to be debited to income statement and both are to be deducted from balance sheet. Estimated useful life. This will help us to find the depreciation during its useful life. Say an asset which you purchased can give you a service for 3 years, 5 years, 10 years, 20 years, like building. So it will help us to calculate depreciation once you know the estimated useful life of the asset. Salvage value. Salvage value is also called as residual value, which is a scrap value when the asset is thrown out. What you get at the end of its lifetime is called salvage value. Say, for example, an asset whose value is say 105 and the salvage value is say 5,000 after a life period of 5 years. So you will get $5,000 at the end of its lifetime. Therefore, when we have an useful life of 5 years, depreciation would be 105 minus 5,000, which you are going to get. This is the expected salvage value divided by life of the asset, 5 years. 105, 105,000 to acquire the asset, 5,000 which is the expected salvage value divided by estimated life will give you yearly depreciation, annual depreciation. So in most of the assets we estimate the salvage value at the end of its useful life. That is also called as residual value. In the next year onwards, in the first year, you know the entries: bank account debit, asset account debit, bank account credit. And also you will have depreciation account debit, accumulated depreciation credit. But second year onwards, you will have again historical value, at what price you purchased, less accumulated depreciation. If you have any impairment losses, impairment means when asset is out of the the condition for and not in a position to use for an intended use, means it becomes outdated or it becomes completely out of or usage area, or it meets with an accident where the asset cannot be used at all. That is called impairment. The life is there, but asset is not in a position to be used in the business. That is called impairment. Of course, we'll discuss about it later. And when you deduct these two values from the historical cost is nothing but the acquisition cost. When you purchased the asset, what amount you purchased, what amount you used to purchase the asset is called initial cost or historical cost or original cost, you can say, minus accumulated depreciation. Here I gave you one point: impairment loss. Impairment loss may be there in the class of an asset, like you have 10 buildings purchased for 1 million minus depreciation, we are in third year, but one of the buildings got damaged due to certain natural calamities. So that building will be no more. So that is impairment loss that should be deducted here. In addition to the accumulated depreciation until third year and the accumulated depreciation of one of the buildings will give you carrying value when you deduct these amounts from the original cost. This carrying value will be the outer column value in the balance sheet. Okay. Now we know the accounting for depreciation entry, but what are the different methods we have in a depreciation? What different depreciation methods we have here? One second. Yeah. The depreciation methods include straight line method, declining balances method, which is also called as written down value method, units of production method, and some of the years digit methods. You have around 8 methods what we studied in our graduation level, but in CMA, please concentrate on these 4 methods: straight line method, written down value method, or reducing balance method, or declining balances method, units of production method, some of the years digit method. Let's go back. Yeah. When you pass an entry for depreciation, it should be like this: depreciation debit, accumulated depreciation. If you have different types of assets like property, plant, and equipment, some companies like to know the amount of accumulated depreciation on a group of assets like trucks, buildings, you know, equipment. So you will have a tagline here: this accumulated depreciation belongs to trucks, buildings, etc. Accumulated depreciation and depreciation, capital expenditure, revenue expenditure. Revenue expenditure is nothing but operating expenditure, what I explained to you. And the methods. Now let us take an example here, a straight line method example. An asset was acquired for 100,000 whose salvage value is 10,000. So obviously when you sell at the end of its lifetime, you would be getting $10,000, which is residual value. And the lifetime is 4 years. So 100,000, after 4th year you are going to get 10,000. Therefore the depreciable value is 90,000. And how much you are getting here? 4 years. 4 years. So the depreciation each year would be calculated. Take your calculator. 100,000 minus 10,000 divided by the life of the asset, 4 years. What is the value? 90,000 divided by 4. Yes, please. 22,500. Each year you will charge 22,500. So your depreciation expense in the first year would be 22,500. In the balance sheet it will be 22,500. Second year again 22,500. But with the last year 22,500, current year 22,500 will become 45,000. So you will have 100,000 minus 45,000, 55,000 carrying value here. Then another 25,000 or 22,500 will give you 67,500. Can I have the carrying value please here? 67,500 is to be deducted from 100,000. What is the carrying value? 32,500. And in the 4th year as well, again 22,500 67,500 plus 22,500, 90,000. Direct 90,000 from 100,000, you will get 10,000. This 10,000 is nothing but the residual value, which is given here. Okay, and in the first year it is to 77,500, no carrying value.
Yes, sir.
So this is the method of showing in the balance sheet. In the balance sheet you will show carrying value. In the income statement every year you will show as an expense, depreciation as an expense. So under straight line method, uh, the depreciation value is calculated using a formula called the cost of the asset minus salvage value divided by estimated life. Now I'll give you one more question. We purchased an asset on January 1st for 20,000. Residual value is 2,000 and estimated life is 90,000 miles or 5 years. So let us take years. What is the amount of depreciation per year?
3,600.
90,000 minus, sorry. What is it? 20,000 minus 2,000
2006
divided by
divided by
5
Fine.
years.
3600.
3,600. If your asset is to be depreciated in hours, like flights are depreciated on hourly basis based on its estimated service life. Okay, so that has to be depreciated by dividing 90,000 hours, 90,000 miles. So straight line method, cost minus residual value divided by useful life of the asset, that is 3,600. So your account will be depreciation is an expense. So always you will have a debit side. Accumulated depreciation is a charge against your asset that has to be credited. So it will have a credit balance like a provision, you can say. So this 3,600 will be charged like this. Depreciation from first year to last year. But in the accumulated depreciation account, you will have 3,600, 7,200, 10,800. 10,800 plus 3,600, 14,400, and in the fifth year it is going to be 18,000. So each year you will have 3,600. The total depreciation would be 18,000. That will become accumulated depreciation at the end of fifth year. If you have any fractional period depreciation, like asset is purchased during the year or asset is sold during the year, so obviously you will have to charge depreciation based on the time period. I gave an example here. Say for example, an asset is purchased on, say, first day of April. First day of April. The acquisition date is April 1st and you are closing on 31st December. So the depreciation is to be charged only for the period of 9 months, from April 1st to 31st December. 9 months. 9 divided by 12. So the amount of depreciation is to be calculated like, if the cost of the asset is 100,000 and the asset value is say 10,000, okay, and useful life is say 4 years. The useful life is 4 years. 100,000 minus 10,000 divided by 4. Yes, please. That is annual
11,000.
that is an annual depreciation times 9 by 12 because you acquired as on 1st of April. So first year depreciation would be only for 9 months. How much is that?
60, 16,875.
16,875. Second year onwards, it is same, 22,500. And the fifth year, if the asset is sold, obviously, if the life is 4 years, see, 1 year, 2 years, 3 years. The 4 years here 9 months and here 3 months. So in the fifth year, you are going to calculate depreciation for only 3 months because the total life is 4 years. See, here 3 years are completed, here 9 months, here 3 months. So total it gives you 4 years. So last year you'll have to calculate depreciation for only 3 months, and it is going to be sold or it is going to be discarded or disposed on March 31st.